Okay, myself Dr. Amit Jadhav. Today we discuss the government finance, one unit we have in the state exam. So government finance is known as a public finance also. So basically public finance, it means that there are various government bodies are there and they are doing some activities. So basically the financial activity we have to consider here. So they have the activities that is they firstly that they try to collect the revenue from the various uh, sources, and they through that the revenue they getting some income, and that income they can spend on the welfare of the society. It's known as a public expenditure. So basically today we discuss about the public revenue, how the government or how the government body collect the revenue, or what are the various sources are available to collecting the revenue, what are the theory behind to collecting the revenue, and similarly we try to find out or try to discuss some effect on the to collection the revenue on the society, or income, or the maybe employment or the saving tendency. So now we have the first slide where we try to discuss about the revenue, and we have the tree diagram where it's showing that government, there are various sources can government can create the revenue. So basically these sources on the base of nature of the revenue, we can classify these government sources to collection the revenue. That is the first, that is a tax revenue, and another classification we can make, that is a non-tax revenue. So basically tax revenue, it means so there are various types of the tax through that the government can get some income on the revenue. So we have the types of the tax. First, that is a tax on income. Next, there's a tax on property, and third one we have the tax on commodities. So tax on income. So there also we have some subdivisions are there. So tax on the income, that will be personal tax or personal income tax, which is a filled by the individuals on individuals' income. And another we have the corporation income tax. It's a corporation. It's related to corporation income, so it will be a levy on the corporation income. So basically, we have the another tax, property tax. So in property tax, we have the gift tax. Another we have the tax on commodities. So there are just basically in tax revenue we have the direct and indirect tax. Also, classification is there, and commodity tax is a one important source to collect the revenue through the indirect tax. So in indirect tax, basically we have the custom duty, which will which impose on the impose on the imported commodities. Otherwise, we have the excise duties. That in excise duty we have the central excise duty, and similarly a state excise duty also, or state level excise duties is there. And third one, we have the sales tax, that is central sales tax and state sales tax. Now we have the GST, that is a goods and service taxes are there. That is also one part of the indirect tax revenue. Other we have, that is the wealth tax and excise duty. So basically, through there are various way the government can. These are the various types of the taxes, and government can collect the money from the through the taxes. Other hand, we have the non-tax revenue. So comparative to tax revenue, government have the quite smaller share in their total revenue, that is non-tax revenue. But there are also various sources can government get the revenue. So first we have the administrative revenue. Another that is second classification is the borrowing. Government can get the revenue from the borrowing. It may be in the domestic, or it may be international borrowing or external borrowing. Next we have the commercial revenues. Third one, that is a gift and the grants. And fourth, we have the issue of the currency. So basically, these are the non-tax revenue through that the government can get the revenue. So basically, in non-tax revenue, administrative revenues, first we have the fees. There are various fees. The government services, the government can charge us various types of the fees. Similarly, we have the license, fines, and other sources also there. That is administrative part, and the government can charge some fees or some price of the source services, and that through that government gets some revenue. Similarly, government another we have the borrowing. The government can get a revenue from the borrowing, that is domestic borrowing, or sometimes they can get the external assistance or external loans, that is a foreign international organization or some developed countries, or World Bank, IMF, or Asian Development Bank. There are various sources where government can get the external borrowing. Through that, also government can raise the fund or raise the money. Afterwards, they have the commercial revenue. So commercial revenue means the price of goods and services which is provided by the government or the government-owned organization or public sector organization. For example, we have the railways, or we have the nationalized banks or other post office. So these are the fully owned by, or these are the owned by the government organization, and they're providing some services or they're giving some goods to the peoples, and they try charging some amount for their service or goods. That through that they also get some revenue. Afterwards, they have the gift and the grant within the country. They can get a gift or some grant within a country or from others country also. That will they through that government can get the revenue. And last one, they have the issue of the currency. So basically, the government have the right to issue a currency. Basically, as a representative of central government, RBI have that right, legal right to issuing the currency. If the government needs some money, basically in a deficit finance, they can get the money, or they can suggest the central bank to print more currency, or to increase the money supply in the market. So basically, tax revenue we have, that is taxes are the main sources of the public income. The government withdraw the part of the people income in a called the tax. And there are several types of the tax. We already discussed that there are several types of tax, basically, but that will be categorized as a direct on and indirect taxes. So through the tax, government can get some revenue. Others, we have the fees. Fees is a one income source. The government provides several administrative and other services to the people, and the consume the services. Government impose some charges or the price of the services. It may be education services, that is an education fees, or court fees, or health fees, or some registration fees. So through that also government gets some income. Afterwards, they have another source, that is profit from the public enterprise. So government runs some several enterprise in a country with the several objectives, and they produce a certain goods and services. So already we discussed about that we have the railway services are there, post office services, or nationalized bank are there. Or these services are LIC also, insurance services. So that services is provided by the government to the peoples, and they're charging some amount fees for their services. So they get some, or these enterprise, they are getting some profit, and this such a profit, or such industries income is become a government revenue, or profit of such industries will become revenue of a government. Next, we have the fine. So the government of any countries establishes rules and regulation and smooth functioning of the society. So basic idea behind the rules and regulation, that will be smoothness functioning of the society. If somebody crossed the rules or somebody broke the rules or regulation, the government or authority can impose some fines, and that fines is collected as an income source of the government, but impose the fine follow impose the form fine impose to the follow the rules of the act. Through the act, they can charge some fine if there some people broke the rules, or they are not act regarding the legal act, so that they can get charge some fine, and through that fine government can get the income. Next, we have the grant. One government gives the grant to another government, like a central government give the grant to the state government, because in our financial structures, or in our country, we adopted the federal system, and in the federal system, the central government have the quite bigger quite higher right and higher income sources compared to the state government, and that's why central government gives some grant to the state government. So basically through the grant also the state government gets some income sometime. And the developed countries are the providing the grant to the poor country or the underdeveloped country or the developing country for a certain purpose. So basically through that also government can get some income from the grants. It may be in internal grant, or maybe sometime they're getting grant from external sources, or the some in terms of the foreign currency donations. So basically in some time of the situation of the adverse condition, like there will be natural calamities like a flood, earthquake, or tsunami, or the COVID-19 pandemic, government collect or government can announce or appeal to the people to give the donations to protect the society from this particular problem, and they collect the donation from the peoples of the nations or the state. Similarly, during the COVID-19, Indian government collect the donation in from their domestic peoples, and to the people or the society individual, they can send deposit their donation in account of the PM Care Fund. So that fund can be used uh, to for the solving the problem. So through the donation also government can get some income source. Okay, basically in a critical situation they can use this source to getting some income. So that is the there is a various sources to get the income, that get the revenue is, and the sources can be, we can already we discuss about the sources. The sources have the tax so revenue, or we have the non-tax revenue. But when we comparing this revenue, so the most of the revenue government getting the taxation or from the tax. Okay, so basically the tax is the amount of income which is a pay honestly to the government by the citizen without any expectation to refund it. So that is a general concept of the taxation. It may be levied on a property, it may be levied on the income at the time of the purchasing goods and services, and selling goods and services. So tax is a compulsory payment to government by the people without expectation of some returns. So that is a taxation. It means it's a compulsory payment to the government by the people, so they are not expecting anything while they are paying some taxes. So that is known as a tax. So basically tax can levy on the property, it will be levy on the income, it is sometimes it will levy on the expenditure or on the goods and services, and sales and goods and services also. So there are, it means there are the direct and indirect tax are available. So there are some definition regarding the taxation. We have the vegetables definition, and according to him, tax is a compulsory contribution of the wealth of a person or a body of a person for the service of the power. So basically, tax is a compulsory contribution of the wealth of a person or body of a person from the service of a power. So basically, it is a contribution, individual contribution in a national services or national activities or countries activities. So final friendly Shiraz also have some definition. According to him, the tax are the compulsory contribution to the public authorities to meet general expenses of the government which has been incurred the public goods and without reference to the patient benefit. So, according to Siras, he tried to explain that tax is a compulsory contribution of an individual compulsory contribution. It may be in terms of the direct, it may be in terms of the indirect tax, and it meet general expenses of the government, because the government also have to do some general expenses. And it may be administrative expenses, some police expenses, or some juridic expenses. And similarly, nowadays it occurs in the public goods expenses or on public goods. So to cover such expenses, it will be compulsory contribution of individuals or people of a country, that is known as a tax. So tax is a, in short, we can say tax is a compulsory payment, and without any expectation, the individuals have to pay a tax. So objective of the taxation. What are the objective of the taxation? What are the objective behind the taxation? Why the government rise the tax or levy the tax on the peoples? So first, to raise the public revenue, to rising the public revenue, because government have to do various activities nowadays. In the modern days, government adopting the welfare economics theme, welfare society. So where government try to do lots of work, and to finishing the lots of their function, to complete their such a function, they need quite a large revenue to and the taxation is the one way where they are able to get revenue. So to rising the public revenue is the one source, because most of the revenue government can get through the taxes. It may be direct and it may be indirect tax. Mostly those are in a developed country, they are getting the taxes in a quite more revenue in a direct taxes, but in a developing or underdeveloped country, they are getting the revenue, more revenue from the indirect taxes, because they have the limitation to increase the tax direct tax player. Next, we have to reduce the inequalities in the income and the wealth. So that is another objective behind the taxation. So reduce the inequalities and inequalities in income and the wealth. So basically, there are the inequalities we see in a society. It means the distribution of the allocation or distribution of the income sources are unequal, or there are some people, they have quite rich peoples out there, and there are some group of the peoples are the poor people. So reducing the gap between the rich people and poor people, government have to impose the taxes on the rich people. They can collect the money through the taxes from the rich people, and they spend such a money on the welfare of the some poor and middle class, welfare of the poor society. So that will be help to reduce the gap between the rich and the poor people through the taxation policy. So that is another objective we have. Next, to regulate the economy. To regulating the economy, the government needs some money in their hand. They need some revenue to regulating the economy. Okay, and that's why they can get the source, that is a taxation. So to increase the national income, to increasing the national income, also one objective of a taxation, to increasing the national income, it means government sometimes government gives a motivation for the production, so that time they can reduce the tax on that particular commodities or the particular for particular industry, and they are motivating the particular industry to promoting particular in industry for the increasing the production. So it will be help to increase the national income. So national income will be increased through the taxation. Next, to establish economic stability. To establish economic stability, also another part basically, and that establishing economic stability through the income, basically in a direct and indirect tax. Basically, that here they are using quite morely direct taxes and indirect tax also. So controlling the general price level or establish economic stability through the taxation policy, government try to control the general price level, or they try to control the inflation in the market. Proper standard. So to achieve the proper standard, proper living standard, to achieve such a proper living standard, government have to government have to achieve the or provide some services, provide some infrastructures, and that will be used if they have the people are getting quite good infrastructures, so their standard of the living will be improved. So next we have to promote the capital formation. To promoting the capital formation, because the country are the underdeveloped, because they are the because they are the uh, promoting the capital formation. It means the country are the underdeveloped because they have the problem of a capital formation, or they have the lack of some low capital formation, and that's why the government the country will be underdeveloped. So promoting such a capital formation, promoting the saving, as well as to promote the to investment, it will be help to capital formation. So political objective, to achieve the political objective also they are behind is done, and that's why these are the some objective or behind of the taxation. Okay, so next we have the that is the principle of the taxation. So principle of the taxation policy basically. So there are various principles behind the taxation policy. First, we have the quite important principle that is given by Adam Smith, principle of the taxation, and Adam Smith have the four principle. To the taxation. First, they saying that the principle is the equality. It is the based on the goods tax system. It is the said that the good tax is the tax which is the based on the principle of equality. It principle means the tax should be levied according to the paying capacity of individual. So the principle are explaining that the tax should be levying according to the capacity of the principle or paying capacity of the individuals. So those have the quite higher paying capacity to the tax paying capacity, those they can levy quite more rate of the tax, and those have the quite lower or they don't have the some paying capacity or their income is quite low, so they don't have some taxes. So basically the equality principle, it will be help to reduce the inequality in a society and create equality in a society, or it should reduce the gap between the rich and the poor people. Next, we have that principle, that is the principle of certainty. So there should be not be confused about the payment of the tax. The tax payment, we don't have any confusion about this payment of the tax. According to Adam Smith, the tax which is individual bound to pay out to be certain and not arbitrary. So there will be no any uncertainty, or there will be no any confusion about the tax rate or about the tax amount. So that will be clear amount will be there, and the tax which is each individual is bound to pay out to be certain and arbitrary. So that is the second principle we have, that is the principle of the certainty. Next, we have the principle of the convenience. So that is another third principle is given by the Adam Smith, and every tax out to be levied at the time or in the manner in which is the most likely to be convenient for the contributor to pay. So while the levying the taxes, that time we have the government or the policymaker, they have to think about the convenient for the contributor to pay the tax. So tax should be levied in such a manner which provide the maximum convenience to the taxpayer and not inconvenience to the taxpayer. So levy such a tax which provide quite maximum convenience of the taxpayer and not inconvenience of the taxpayer. If they are facing inconvenience of the taxpayer, so they are not ready to pay tax, or they avoiding the taxpayer to pay a tax. So that also therefore the third principle is quite important, the principle of the convenience. Fourth, we have the principle of the economy. So it means the cost of the tax collection should be minimum, means negligible. It means the maximum amount of the tax collection should be deposited in the government treasury. So collect the tax in a proper manner and charges minimum rates that may be quite negligible, but through that they can get quite higher amount, and to contribute maximum amount of the tax collection should be deposited in a government treasury, so government can get some money, and that revenue, can use for the development or the some improvement of the economy. So these are the four principles are the given by the Adam Smith for the imposing the tax or the levying the tax or the society. So in the taxation policy, that these are the principles behind the taxation. So first we have to think about the principle of the equality. Second, that is the principle of the certainty, and third one we have the principle of the convenience, and fourth, that is the principle of the economy. Next we have the tax theory. So there is a tax theory is given by the Adam Smith himself also, and according to him he tried to say the ability to principle the ability to pay principle is widely expected, and in scaling the justice of the equality taxation. So it will be widely expected in a global level because it's a clear justice and the equity through the taxation, and the tax has been paid according to his ability to pay. So tax has been paid or has been to pay according to his ability to pay. It is based on pose of the income property of the person. So the tax are tax has been to pay or tax are levy on the person according to their ability to pay, and ability to pay will be decided through the following some factors. First, the property. Okay, if the person have the quite higher property or quite higher amount of the property, so he can able to his ability will be quite high, so he have the ability to pay a tax. So income also have the impact on the ability to pay. So income and the sources of the income. If a person have the a person or the group, a family have the various sources of the income, and they getting the income in quite larger amount, so they also have the ability to pay a tax. Size of the family, as the size of the family have the impact on the ability to paying tax. If the if individuals have the quite higher there are larger numbers in a members in a family, so it means they have to spend too much amount on the fulfill need of the basic needs of the family. So there will be quite low amount will be remaining for this imposing the tax, or maybe they don't have the such amount surplus amount. So the size of the family, if the size of the family is quite big, it have the adverse impact on ability to pay. So if the size of the family is quite higher, or there are number of the members in a family is large, the ability to pay will be reduced. And if the number of the family member of the family in a family is less, the ability to pay will be increasing. Now, next we have the consumption expenditure. So consumption expenditure also have the impact on ability to pay, because if the customer individuals consumption or as well as the family consumption, if they have the quite high level consumption, so their ability to pay will be reduced. If their consumption is low, then the ability to pay the tax will be quite increasing. So it means the ability to pay of a taxes, it are different on the some variables or some factors, and that factors are known as a property, income, size of family or size of the member of the family, and the consumption expenditures. So that theory is known as the ability to pay. So while imposing the tax, before the imposing the tax, government or the planners, they have to think about the ability to pay of the particular person or group of the person. Next, we have the direct and indirect tax. So there are basically two main classification. Already we discussed about that. So there is a direct tax and indirect taxes. According to Professor Dalton, a direct tax is a really paid by the person on whom it is a legally imposed, while the indirect tax is imposed on one person, but paid partially or wholly by another person. That is known as an indirect tax. So basically, so direct tax is a individual tax, and it will be paid by the individuals. It will be imposed on the individual income or the individual property, and it will be paid by the only the person who levied on the tax. But according to in Dalton, indirect tax that will be paid by the another, maybe shifted from the one person to the other person partially, or wholly shifted from the one person to the another person. So basically, the direct tax is that person or the institution pay directly to the authority. Okay, impose it. According to Dalton, also he tried to say the direct tax is the tax which really paid by a person whom it legally imposed. So the whom is the legally imposed, that amount will be paid by the really person. So it's known as a direct tax. So basically, so we have to, there are various types of direct taxes. So already we see in a first slide, that is the property tax, income tax, basically property tax and income tax. So basically, direct tax have some merits of the direct tax. What are the merits of the direct tax? First, we have the merit or advantage of direct tax. That is, the direct tax are economical. Cost of the collecting this tax the authority is relatively lower. So direct tax is economically, and cost of the collect such a tax is comparatively quite low for the authority, because automatically the tax will be cutting through the income of the individuals. Next, we have the direct tax are easily to flow a progressive principle, or follow the progressive principle which directed by the principle of equality. So it will be following the progressive principle. It means the progressive principle means those have the higher group, the tax can be charged quite higher rate, and those people are the lower income group, the taxes will be charges in a lower rate. It's known as a progressive principle, and it's which is quite close to the equality principle, because here also through the progressive principle, the government tried to establish equality between the society, between the rich and poor people, or they maybe try to reduce the difference between the rich and poor people. Next, we have the direct tax are useful to decrease income inequality from the economy. So they are also useful to decrease the income inequality from the economy, because these taxes are charges on the quietly rich peoples, those have the quite higher income, the certain beyond certain level income, and they can collect the taxes from such a person, and that revenue will be spending on the welfare of the common society. So that will be help to reduce the inequality in the economy. Next, we have the certainty. The direct tax to satisfy the principle of the certainty. So direct tax is to satisfy the principle of the certainty, because in a direct tax the rate will be fixed, and that will be quite certain. We don't have any certainty in collection of the direct tax. We don't have too much certainty. There will be certainty, but we don't have any too much certainty. So basically, elasticity. So this tax amount increase with increase in a tax rate, and direct tax fulfill the principle of the elasticity. So if the income increases, if government want to increase the income through the taxation, so what the government have to do? Government have to increase the tax rate. If they increase in tax rate, it means automatically the amount of the tax collection of direct tax collection will be increased, and it means they have the principle, that is elasticity principle is there. Next, we have the awareness among the people. The people are aware about the paying taxes. This is not applying for the indirect tax. So awareness among the people. So basically, the people are aware about the paying taxes, because the amount will be cut, the certain amount will be cut through their income, but that is awareness is not applying for the indirect tax, because indirect tax we don't aware about the tax paying, and that the amount is quite negligible. So easy to the understanding, the direct tax is are easy to understand, even the common people. So basically, it will be quite easy to understand. And similarly, direct tax create the civic consequence among the masses, people become aware about their right through the direct tax. They may be aware about their right because the people now they are paying some amount to the government, and so therefore they are awareing their right also. So that are some merits of the direct tax. Similarly, we have the demerits or some disadvantage of a direct tax also. So we have the unpopular tax. Basically, direct tax are the imposed collected directly from the taxpayer, and it appears quite painful to the taxpayer. So it is a unpopular in a public. So direct tax is a quite unpopular in a public because it is appear quite painful because the individual have to pay some amount or some shares of his income to the government in terms of the tax, and that is quite painful to the individuals. So inconvenience of the tax, it is found that taxes are requiring the numerous accounting and other formalities. So there are various formalities needed to while we're filling the taxing. Now it will be quite easy to pay our net tax, but before that, that is quite inconvenience to fill the tax. Next, we have the uneconomical tax. If there are number of the taxpayer with comparatively low income and high cost to the collection of the tax, collection to the less tax amount. So the collection of the tax require more staff and more machinery to collecting the amount. So that is a quite uneconomical tax also created. So if in a direct tax, they're quite comparative low income group charging some taxes. So that time it will be quite a high cost to collection of the tax revenue, and it will become an uneconomical tax. Next, we have the changes of the tax evasion. So there are the possibility to tax evasion because the people are not always ready to ready to pay the government without any earning on it, and the taxpayers sees directly sacrifice some amount of their income, and they are not happily to sacrifice their amount of income. So there will be some tax evasion also. Uncertainty in the tax, sometimes the uncertainty in the tax, for example, in 2020, in India, the person who is earning more than 5 lakhs rupees should have to pay 5% tax on the amount between the 2.5 to 5 lakhs. If the person has a less than a 5 lakhs annual income, have no tax. So there are we have the uncertainty. Sometimes there will be uncertainty created by the government because they're giving some nowadays they're giving some new tax rate and the old tax rate, and through that it will be uncertainty will be created among the people. So big obsolete capital formation. So sometimes it will have the adverse impact on capital formation because to paying a high amount of the tax to the government, it have the adverse impact on the saving, and if the saving is a decline, it also have adverse impact on investment and the capital creation. Narrow scope of direct tax are the unuseful to bring a civil consequences among all the people because it is levied only the certain income group of the society, and that group of the society is quite smaller to compared to the total population. And the political interest also is the one drawback of this direct tax. And the political interest government tries to levy heavy tax on the rich peoples and expect the poor people to show the government is the what the poor middle class people are against of the rich people. So there will be group will be created, the rich peoples and the poor or middle class people, and they maybe can stand opposite to each others. So that also political interest also we can have. Next, we have the indirect tax. So basically, indirect tax are the tax which are the collected indirectly from the taxpayer. So these are the levy on one person and shifted to one person to other person. It may be fully or partially shifted, and it's called the indirect tax. So indirect tax have also merits and demerits. Here also we have to think about. Most of the time, while we purchasing some commodity or services, that time we are paying some tax, but the tax amount is quite negligible or quite small amount. So we are not aware about the paying the tax. Such tax is known as a indirect tax, and GST also one part of the indirect tax. So basically, there are merits or the advantage of the indirect tax. Indirect tax are distributed in a small installment which are the convenient to the pay. So indirect tax is collected very small amount, so it is quite convenient to pay. Indirect tax are the highly elastic, so they are quite highly elastic. So if the government want to change the tax rate, they can easily change the tax rate, and the revenue also change. So they have the highly elastic taxation. So tax evasions impossible because the direct tax are already included in the price of the commodity. So basically, the tax evasion is impossible because of the indirect tax already tax are included on the price of the commodity. So while the consumer purchasing the commodity, if they give the price, that time they give the tax, the paying the some amount of the tax also. So reduction in unhealthy goods is a good for the welfare of the society. So reduction of unhealthy goods, maybe liquors or some tobacco products that will be government try to reduce such a demand in a society. So they try to increase the tax on the particular product, and they thinking that if the price of such product increasing, it will be have the adverse impact on their demand. So indirect tax are easy to collect. Similarly, it was quite easy to collect compared to the direct tax. Okay, so these are the some merits of the indirect tax. We have the demerits of the indirect taxes. So indirect tax are the regressive in a nature. Regressive nature, it means the tax are paying in the same rate for the each and every group of the people. So if a person purchasing one commodity and the tax is the 10%, so if a particular person is rich, he have to pay 10% while he purchasing the commodity. Similarly, if the poor person also want to purchase such a commodity, he also have to pay 10%. So basically, the tax are the regressive in nature. It is very difficult to anticipate the tax revenue about the indirect tax. It is quite difficult to estimate amount of the how much amount we are getting from the indirect tax, because that amount will be depend on the demand of the goods and services which is done by the people. About the tax, indirect tax, the customer unable to feel or to see about the burden of the tax. So then customer is unable or he is not aware about the burden of the tax because the tax amount is very low or is negligible, and it will be included in a price. So he's not aware about the he paying some taxes. Another tax, indirect tax, are more inequitable because about the indirect taxes, poor person pay more proportion of the income. So poor person have to pay more proportion of his income. For example, if a person want to buy a commodity and A and B, A person and B person, we are assuming A is quite a rich and B is so the poor person. So A's monthly income is a 1 lakh rupees and B's monthly income is a 10,000 rupees. So basically, the commodity price is 100, and A can purchase the commodity. That time they pay the 10% tax. So similarly, B also have to pay the 10% tax. But the tax amount is the same. But when we think about the proportion of the tax amount to their income, the poor people can pay more proportion to their income as a tax because their income is low compared to the rich people. So that is another, we can say, the limitation of the indirect tax. Next, we have due to the indirect tax, people have to pay more on the purchase of the necessary goods and services. So if such a tax are imposed on the necessary goods and services, that time the poor people or middle class people have to pay more amount or more proportion of their income on purchasing such a commodity. So these are the some demerits of indirect taxes. Now we have the concept that is a progressive tax. So with the progressive tax, already we discussed about the with the increasing the marginal average income of the worker, the tax rate is increasing. So if the income is increasing, the tax rate is increasing. If we have such a tax rate, that time we can say that we have the progressive tax policy. Proportionally tax policy is no proportion tax policy is a tax which equal to the all income group of the tax payer, and tax proportion tax causes the substitution of the income. So where we have to take into account to proportion to the income, how much they are charging the taxes or paying the tax. So there are some important tax types of the taxes. Basically, we have the income tax. So income tax is being the implemented to the bring of virtuous as well as the horizontals, vertical horizontal equality, and based on the principle of the ability to pay principal. And income tax is a generally progressive tax because it levied on high rate on high income group and it less rate on a low income group. That's why the that taxes are known as a progressive taxes. Another tax is important that the corporation taxes. The corporation taxes is a direct tax. It is a tax levied on the income earned by a corporate bodies or the firm, and the corporate bodies corporation tax is paid from the taxable amount, and when we minus this taxable amount, the remaining amount is known as a net profit earned by the corporation. So during the financial years, after the paying the corporation tax, the remaining amount of the profit will be distributed among their shareholder as a dividend. So corporation tax also one part of the direct tax. Next we have the expenditure tax. Expenditure tax is a direct tax and it levied on the amount of the consumption and expenditure of the player of the certain enlisted income. So commodity taxation. So another we have the commodity taxation, or which is known as a quite indirect taxation. So basically, excise duty. The excise duty is a tax levied on the production of the commodities before and reach to the consumer. And according to the Constitution of India, the central government is imposed to the levy excess duty on all the commodities produced in a country or within a country, excluding the alcoholic, liquoric, and optimum and others narcotics. So that because that will be charges by the taxes through the state government, but other commodity the central government can charge some taxes, and that tax is known as excise duty. Custom duty, the tax levied on the foreign trade are called custom duty. So custom duties are collected from the main two heads. First, we are they are the import duty and the export duty. So import duty is a charging on import commodity, and simply we have the export duty which is charging from the export commodity. So that is the some important tax we try to discuss. Now we have the GST also. There is a goods and service taxes, and that rate will be fixed by the central government, and that will be applied overall India. So unique rate will be there, and central government basically collect the tax through the indirect tax through the GST, and some shares of that collection they can transfer from the center to the state government. So now we have to think about the effect of the tax on saving and labor supply or workforce. So there are some effect on tax on saving and labor supply. So first we have the income effect. Individual typically make some different decision when their income changes because of the they are they have to pay more taxes because they are the poor. They postpone their retirement, or they cannot be enjoy more leisure. This known as the income effect. So basically, if the charging the quite too much taxes on the income, so that time it will be the cause of the quite adverse impact on the retirement policy, or they cannot be enjoy the too much leases and can known as income effect. Substitution effect to the attempt the avoid the taxes, substituting the non-taxes and the tax activities are the called the substitution effect. So there are some financial effect also we have to think about that. By the providing the executive with the stack option, the firm are available to lower and the lower imposed on their managers the evasion and the tax through the cash flow. So hidden economy is the or that economy also known as a black economy. So it will be created quite a bigger larger amount. So income taxation and the labor supply. When we thinking the income taxation and the labor supply, these refer to the decisions about the hours of work and the participation. The basic model of the labor supply postpone that the individual's labor supply is function to after the tax wage and tax income from their own sources. So these are the impact or these are the effect on the taxation effect on the saving as well as a labor force. So basically, if you are charging quite a higher amount of the taxation, in that maybe direct or indirect tax, it have the impact adverse impact on the saving tendency. The saving will be reducing, and the saving reducing it means it will be have the adverse impact on the investment as well as the on the capital creation. Similarly, we have the impact on the labor side also. If the people have to pay more amount or more shares of their income as a tax to the government, so they don't have to they don't motivated to work more hours. They try to we they don't have motivation to work more hours, so they can prepare to leisure compared to the work hours. So that the labor supply also or labor are not interested to work more in a production process. So these are the some impact on the taxation policy. So through that the government can get some revenue. So now we are able to conclude today's lectures. What we have to do in today. So basically, today we try to explain the revenue part of the government and where the public revenue and how the government can get the revenue from the taxation and non-tax revenues are there. So thanks once again. So those are the attending lectures. So next lecture we can discuss about the uh, public expenditure. Thanks to everyone. Thank you.